We're back to talk about stock options today, but specifically, this video is going to be all about incentive stock options, or ISOs. Hey everyone, welcome back to the channel. Jake Turner here, Associate Financial Planner at Financial Design Studios. And like I said, we're going to talk about incentive stock options today. So what are incentive stock options? If you clicked on this video, you may be receiving these. And if so, this can be a great part of your overall compensation. As we talk about ISOs, we're going to talk about 3 different areas that are helpful for you to understand so you have the knowledge to make sure that you're using this great tool and maximizing your income while minimizing taxes paid. So we'll talk about over here, we'll talk about the structure of the incentive stock option and some key terms that come in with that, as well as some key dates. We'll talk about some other terms that you may see thrown around, define those for you so you're crystal clear on what those mean. And then finally, we're going to talk about the tax consequences. And I'll walk through this chart and explain exactly what this means so that you can maximize your tax savings, which is really one of the benefits of the ISO. So let's think about corporate executives. If you're watching this video, you may be in a 32, 35, 37% marginal tax bracket. Really, the value of the ISO is that you are given and able to sell shares of your company's stock and take advantage of those lower capital gains treatments. So ideally long-term capital gains, which are going to be at that 15 or maybe 20% rate versus your ordinary income. So let's talk about the incentive stock option. So you are going to be given these as part of your compensation package. And there's going to be what's called a vesting schedule. So your vesting schedule basically just means the point at which these are granted and you're actually able to do something with them. It could be a year, it could be 2 years. Sometimes you'll get, let's say you get 1,000 stock options that'll vest, 250 year 1, 250 year 2, 250 year 3, etc. Or there'll be a cliff to where you're given those 1,000, you need to hold them, let's say it's a 2-year cliff. You have to wait 2 years from when you're given those options, and then they are all vested in that at the end of that 2 years. That's what I mean by cliff. So a couple key things to remember here. Grant. So this is the number of options that are given to you at what will be called the grant date. And when you're granted those options, there will be what's called a strike or an exercise price. So for example, let's just say that you're given these options with a strike price of $5. All right. Now, you haven't exercised those yet. You're waiting for them to vest. Now let's say that they're vested, they're yours, and you decide that I want to exercise the options that I have available to me. So the exercise date is when you bring money forward to purchase those options that were given to you. So in our example, let's say $5. Let's say the market price of the stock is $20. So you're given the opportunity to buy those options at $5, even though they're trading at $20 on the market. So let's say 100 options at $5 an option. You need to come up with $500 to buy those 100 shares, and now they are yours. You haven't sold them yet, you haven't gained anything yet, but those are your options. Okay, so we've exercised the options, and now we decide it is time to sell. I want to sell these shares, these options, and get the money from the sale of those shares. That's our sale date. When you sell those shares, you are going to pay tax on the gain from those shares. And we'll get down to whether that's short-term or long-term and what that means in just a minute. But one thing I want everybody to remember, this 2/1 over here, in order to qualify for the options to get the preferential long-term capital gains treatment, you need to hold those options 2 years from the date of the grant and 1 year from the date of the exercise. So 2 and 1. And if you can remember that, the taxation will make sense in a minute. So let's talk about that taxation. Let's follow this chart through, and maybe this will help kind of bring it all to life. So in our fictitious example here, we've got our price of the stock over here on the y-axis, we've got time on the x-axis. We have a strike price of $5. I know this isn't to scale, but just bear with me. So we decide to exercise we're in the money, what the term in the money, so it's over the strike price, and that's the value of the stock trading on the market for publicly traded companies. Now, if it's a privately traded company, it'll be there's a valuation that's going to need to go on there, but you'll be told if it's not a publicly traded company whether it's in the money or not. So we exercise, the shares become ours. right? We have put those in play. We don't pay any tax, and this is one key difference between the non-qualified stock option, and we have a whole video on that we'll link to in the notes here, and the ISO. There's no taxation at exercise. However, there is what's called an AMT adjustment. And a little brief tax lesson here. AMT stands for Alternative Minimum Tax. And what essentially the alternative minimum tax is it runs alongside your regular income tax system, right beside it. And for some of those who are making a certain amount of money, typically higher compensated individuals, you may run into a situation where your AMT exceeds your regular tax and you're gonna pay a little bit of extra alternative minimum tax in that year. But usually, if this is done as we're describing here, that won't be an issue for you. So we have our AMT adjustment, we don't pay tax, we wait another full year. Let's say the stock is now trading at $40 per share. Remember, our strike price was $5. We exercised at $20, now we're selling it for $40. We have a negative AMT adjustment at the sale, as long as we've held it for those 2 years from grant, 1 year from exercise. We have what's called a qualifying disposition versus what would be called a disqualifying disposition. Let's say you held it, you exercised it in a year, and then you sold it the next day after you exercise. That would be what's called a disqualifying disposition. And essentially what that means, rather than paying long-term capital gain rates, you're paying short-term capital gain rates, AKA your ordinary income rates. So think about that. If you're in the 37% marginal tax bracket, you're gonna be in the 20% capital gains bracket most likely. So you're saving 17% in taxes by holding on to those options and not selling them for that 2 years after grant, 1 year after exercise. Okay, so another term that we have up here is what's called the bargain element. And you may see that thrown around if you've researched ISOs at all. The bargain element is essentially this right here. It's the difference between the fair market value when you exercise and the strike price. So that will be called your bargain element, and that is pulled through as your AMT adjustment here. So I know this is a lot. ISOs are not the most simple stock option out there, but be sure if you are given ISOs that this is something that's helpful to you. If not, we have some great resources on not only non-qualified stock options, but also restricted stock units, which seem to be much more common, at least in 2023. In summary, incentive stock options, or ISOs, can be a nice compensation benefit for certain employees if the company does give you this as part of your compensation. They are an option to purchase shares of your company's stock at a discount. There are some things that you need to take into consideration that we talked about. Our 2-in-1, remember? 2 years from grant, 1 year from exercise gets you to that qualifying disposition. And what does that mean in layman's terms? That means you're getting those beneficial, lower, long-term capital gains rates when you decide to ultimately sell those options. And when it comes to tax planning, timing is everything. Remember that 2-in-1. So please download a copy of our tax saving strategies PDF. You're gonna find a ton of great tax saving strategies in there. And if you like this, you're gonna like a lot of the other videos. Also check out our podcast, Behind the Designs, wherever you listen to podcasts. Thanks again for watching, and we'll see you next time.